So the banks are not rooting for you to pay off your loan fast because this is how they make their money. And you have to understand that each payment is split into your principal and your interest. And upfront, every payment goes mostly towards paying the interest, not paying your actual home loan itself. But there are strategies that can help beat the bank and cut down their profits, which we'll go over today. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I put out educational videos every single week. So if you'd like to support, hit that like and subscribe button. Now let's get into it. And many people are shocked to know that at the end of the loan term, you're pretty much double paying for that home. And on a $350K loan at a 6% interest rate, your monthly payment is about $2,098 a month. Now, the total amount paid over the 30 years is going to be close to $755,000, and almost $405 of that amount is going straight to the bank's profit. That is the amount of interest that you pay. And this is the part that no one really explains, but it changes everything. And it's how mortgage interest is actually calculated. So the bank charges interest every month, and it's based on the amount that you owe. So they take your interest rate, they divide it by 12, and that's the amount of the monthly charge. Now, the bigger that your balance is, the more interest that you'll be. And you're really paying the bank first, then your home second. So out of this example, the total monthly payment is going to be $2,098 a month. That's principal and interest. Up front, in the very first years, $1,750 of that payment is going straight to paying interest. And then what's left over, which would be $350 a month, is going towards your actual principal balance and paying down the loan. And this is why 30-year mortgage feels like an endless trap, because of how the mortgage amortization schedule works. Is up front, your principal payments, they start tiny and they grow over time. And interest dominates the very first few years, and that's why the first years are the more expensive, because the interest is front loaded. And normally, if we use that same example, $350K loan at 6% rate, year 18 is where the cutoff point is, and that's where the table shifts. And that's where you'll start paying more towards the principal than paying towards the interest. And here's how you can save thousands in paying interest. So strategy one is going to be set up bi-weekly payments, which essentially is you are splitting half payments, making a half payment once every 2 weeks. And at the end of the year, that's going to equal to about 13 full payments. And this will save you in paying almost $73,000 in paying in interest, and will also shave off your loan. You'll pay it 5.5 years fast. So if the bank doesn't allow bi-weekly payments, here's an alternative way instead that'll get you the same result. So you're gonna take your monthly payment and divide it by 12. Then you're gonna apply that amount to the principal amount every month. And this will equal to one full payment every year, which is gonna give you the same results as if you had the option to set up bi-weekly payments. Then strategy number two is going to make extra quarterly payments, which is going to give you the best results. So if you make one extra payment once every 3 months and apply it directly to the principal balance, in this example, this is going to save you over $100K in paying an interest, and you'll pay off the loan 10 years faster. And strategy number three is going to make your first payment early. So if you make your first payment a month before it's due, and apply it directly towards the principal amount. By doing this, this will save you $10K in paying interest, and you'll also saves you about 6 to 8 months off of the life of it. And mortgages don't get cheaper over time. They get cheaper by making principal payments early on. And the reason why all of these three strategies works is because number one, it reduces the principal amount up front. It also lowers the amount of interest that's being charged, especially if you do this in the first couple of years. And also, it compounds savings over decades. And if you're looking to buy or refinance in 2026 and want my help, click on the link in the description, schedule a call, and I'll be in touch.